April is the cruelest month.
T.S. Eliot was off by a month. May has been the cruelest month for investors by far, with everyone still worried about the Europe debt crisis and how bad it might get. Now the question is, the May stock plunge, is it just a correction or the beginning of a new bear market? What do you guys think? Many of you think it's not even the right question. John Beadle pointed out that this is the same bear market that began in December 2007. That's an interesting point, and he could be right. History could turn out to show that the rally from the March 2009 lows could be just a short-term blip in what turns out to be a longer-term bear market. That's happened before, and it could happen again. However, Alan Slaughter wondered, are those experts usually right, or are they cheerleaders? A number of experts who are actually right much of the time have given significant technical explanations why they believe we are on the down escalator for a while. That's definitely something that a lot of readers are concerned about. Some worry that the market and economy are still very fragile, obviously, as well. Harry Joel Silverman writes, look at what the Fed has done or not done. 1 year after the beginning of the recovery, Ben, he's referring to Bernanke obviously, has kept the Fed funds rate at or near zero with no indication of any upward change for the indefinite future. I don't believe the Fed has ever taken this stance so far into a recovery. Is Ben worried? Does he see structural damage here that has not been seen in these so-called ordinary recessions since World War II? Very good point there. Clearly, the quote-unquote Great Recession of 2008, early 2009, was not an ordinary recession. It was much worse than any of those post-war recessions. And because of that, the Fed has felt that it needed to take some unprecedented steps. There are some people now saying that the Fed might keep rates here until 2011 or even 2012 because of the problems in Europe. Speaking of the Fed, which many buzz readers like to do, John McDonald argues that the market bounce from those March 09 lows is just a new bubble created by the Fed. This current rally is so similar to the 2003 rally, both caused by the Fed's easy money policies that almost guarantee market bubbles. This rally, however, may be over even though the Fed continues with easy money. Why? Perhaps because 2007 stock market bubble bursting lesson has not been forgotten, or is it because the real fundamentals of the world debt bubble, U.S. included, are starting to sink in? I mean, what we had in the real estate bubble was clearly one of the culprits behind it was rates being so low for such an extended period of time. Maybe the market rally from March 2009 was another bubble that has already just popped, and also the sovereign debt crisis. Many countries around the world, not just Europe, and obviously not just the U.S., binged on debt, and that's definitely coming home to roost now. So that's obviously something to be worried about as well.